Hey Bowtie Nation, Joseph Hogue here with a fun video today, but no less important to making you a better investor, because today we're counting down to the top 10 dumbest things said on Wall Street. The 10 investing quotes and advice that are so moronic, so meaningless that you'll wonder if it's CNBC or Ringling Brothers Circus. Nation, just flip on your favorite investing show or click over to any website, and I guarantee you will hear these all day long. Investing advice that sounds smart but makes absolutely no sense when you actually try to use it. Or worse yet, it loses your money. And the real tragedy is that a lot of these investing ideas could be good advice if the mindless zombies masquerading as experts just added a few words to them. In this video, we'll count down the 10 worst pieces of investment advice by the experts. I'll show you what they say and what they actually mean, then reveal how to look at each to make better investing decisions. We're getting started, but you know I've got to send that special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of the community yet, just click that little red subscribe button. It's free and you'll never miss an episode. And we're starting with the most popular investment advice here, but also the most dangerous: buy the dip. This first one could be the most overused investment advice in all of history, repeated anytime a stock falls 0.5%. And the problem here, what you'll see in many of these worst investing sayings, is that it's so vague that it does more harm than good. The idea here is this expert is saying they're bullish on a stock or the stock market in general, and they don't believe this little dip in the price is going to become a full-blown stock market crash. Even then, the words here are persuasive. It's just a quick dip and the stock price is going to move higher. But the reason this is so ridiculous is that nobody ever says what that dip is, how much of a dip you should be watching for, or what happens when a dip becomes a drop. Investors here buy the dip and they buy more stocks every day when the stocks drop 0.5% or less. That's fine in a market that only seems to be going up, but what happens when that dip is actually something more? Investors push all their money into a few dips, then start borrowing on margin to invest, and eventually reach the end of the rope before the market is actually done dipping. To give this investment advice meaning though, you need to do more than just jump at every dip in the stock price. Set a target on the stock for a larger drop, maybe 3 to 5% before you go bargain shopping. Set limits to how much dip buying you're going to do before you hold your remaining cash for that bigger drop. Pick just a few stocks from your portfolio, so only the very best, the ones you really like, for those that you're going to buy the dip more frequently, so you're not chasing every stock lower. Number 9, another favorite but meaningless piece of advice: buy quality stocks or quality companies. Nation, this could be the single laziest advice investors will ever hear. Buy quality stocks. Basically, the expert here is just saying they don't know what the hell you should buy, but if you take their advice and still lose money, it's your fault, because obviously you didn't buy a quality company. And if the analyst means anything, usually they mean value stocks here. Stocks with lower PE ratios and strong balance sheets. And stocks of companies in stable industries with consistent cash flows, rather than growth stocks that, while maybe they're good companies, usually have those less stable cash flows and higher price stocks. Using this definition though paints the expert into a corner with value stocks versus growth, which hasn't worked out since the financial crisis. In fact, the difference in returns has only increased between that definition for quality. So instead, the pundit or expert just leaves it vague. It's much easier to say buy quality and shift the blame to the investor than to say what you really mean. Folks, I'm going to let you in on a dirty little secret of Wall Street, one I learned over more than a decade of working for venture capital and private wealth management: that most of the people you see on TV, the experts, are just complete morons. They've been trained on that steady diet of investing quotes, and it's so much easier to just regurgitate this nonsense than it is actually to say something meaningful and take responsibility. Now, part of this advice is just unsavable because, well, no shit, you should always be buying quality stocks. In fact, anyone out there, if you're buying crap companies, just let me know in the comments below and I'll tell you where to mail the check. But there are a few other things that you can do here to give this advice a little more meaning. First, have an objective measure for how you define quality and what you're looking for in the financial statements or the ratios to find those best stocks to buy. Also, don't feel like you have to jump on every stock pick. Limiting your portfolio to just 15 or 20 stocks you really like, it's going to mean you're only in those quality names. We've still got 8 more investing quotes to reveal here, but if you want good investment advice, get the weekly Bowtie, our free market newsletter with the most important news, investing ideas, and the strategies you need to know. It's totally free, just something I like to do for all you out there in the community, so look for the sign up link in the video description below. Next up, a favorite of Warren Buffett: to be fearful when others are greedy, and greedy when others are fearful. But what does it mean? And this is another one that sounds so smart, like the kind of stock market wisdom that's gonna make you rich. The market can be a wild roller coaster of prices. If you were able to buy into the S&P 500 at the lows over the last 30 years, when investors were panicking, when they were fearful, and sell when they were the most greedy, you would have turned a 10% annual market into a 15% bonanza. That's a difference of getting 16 times your money versus 68 times. But as they say there, the devil is in the details on this one, and nobody ever says when exactly to be greedy or to be fearful. Every day since the bottom of the financial crisis, all 4,500 plus days, someone has wondered, are investors being too greedy? Are stocks too expensive? And every single one of those days, you would have lost money being fearful. Now, there is a lot to be said about this idea of going against that herd mentality. It's one of my favorite strategies, mainly because I'm an argumentative asshole, but also because it can produce higher returns if you do it right. Being fearful or being greedy just means managing your stocks, your bonds, and your cash in a way that lets you take advantage of these overbought or oversold markets, but still leaves room to profit if you're wrong. Now, if you think stocks are expensive and investors are being greedy, you don't sell out of everything all at once. You take some profits, hold maybe 20% in cash at first. If the market keeps going up, maybe you sell another 10% and hold it in cash or bonds. Do this in stages like this, and have a formal approach for when you're going to buy and sell, not just when some market hack on TV says so. Number 7 on our list of worst investment advice: being cautiously optimistic. This is the ultimate in trying to hide the fact that the talking head on TV doesn't have a clue of where the market is going. Basically, what this is saying is that stocks could go up or down, but the analyst doesn't want the responsibility if they're wrong. And you're going to hear this most when stocks do look expensive, when there are real economic reasons that the market could stumble, but prices have just kept on rising. The analyst doesn't want to reach down, grab a pair, and make a decision. It's that ultimate safety punt because, hell, given enough time, everyone that's cautiously optimistic is proven right. Even if stocks fall the second those words are uttered, the market is going to eventually rebound and prove the optimist right. Now, the best thing to do when you hear someone say they're cautiously optimistic, after you stop laughing anyway, is just to list out the reasons to be either. Lay out the reasons to be optimistic in stocks versus those reasons for the near-term weakness, and make a decision. Nation, you can be optimistic and make money. You can be a market bear and still make money. When you will not make money is if you try being wishy-washy and sit in the middle of the road without the strength in your convictions. Next on our list, you hear this one a lot: taking the wait-and-see approach. This is a favorite of economists, a profession so unsure of itself that it makes astrology look credible. A big problem here is that investors and analysts like to cling to their past decisions, even in the face of contradictory data. If the analyst previously called for stocks to keep rising, but then the jobs number is surprisingly bad, they're going to take that wait-and-see approach instead of honestly reevaluating that past decision. In reality, though, it's just another excuse to avoid making that decision. The analyst is going to point to some other market question that they're waiting on for more clarity, and believe me, there's always another question to wait on. Nation, there's a term used in the military called the fog of war, and this just means that you'll never have complete certainty about a decision, but you need to balance that uncertainty with the urgency in making the decision. The general that waits for complete certainty on the success of his strategy is going to be outflanked by the enemy that took that chance, that made their decision without waiting. And it is the same thing with investing. You will never know everything that you want to know about a stock or the stock market. There's always going to be some uncertainty, but nobody ever made money waiting to invest. Think through the investment with everything you know and make a decision. We're halfway down the top 10 dumbest investment quotes, and here, anytime someone says the market is climbing a wall of worry. Now, this one is actually supposed to be a positive for the stock market, though some pundits are going to use it wrong. It's supposed to mean that because some investors are worried about an upcoming event or market data, that there's still some cash that can be invested and push prices higher. Here, if everyone was overly positive on stocks, then there'd be nowhere to go but down. Everyone would be fully invested and stocks would be priced to that perfection. But this is just another cop-out because, like we saw with that last graphic, there is always something to worry about in the market and always someone worried. If it's not the economy, then it's earnings investors are worried about. If it's not that, it's politics. There is always something, and by just using these blanket statements like this, it's just an excuse to not actually do the analysis on how these market factors could swing prices. For this, instead of just making those vague statements, you can actually quantify how much of the market is worried and how many people are fully invested. You can look at data like the net margin debt. Now that's the amount investors have borrowed to buy stocks, and it always surges as too many people get optimistic and right before a market crash. Another data point here, you can look for the number of stocks making their 52-week highs versus the lows to see how worried the market truly is instead of just making these ambiguous assumptions. Number 4 on our list, one of my favorites, this time is different. Actually, this one isn't used nearly as much because everyone recognizes it as a joke when it's said, but like the rest of the sayings, you need to go beyond that vague soundbite. Now, the idea with this, saying this time is different, is usually an attempt to explain a high price for a stock or the stock market. To explain why, even though in the past when stocks were this expensive and the bottom just fell out of the market, despite that, there are factors right now that can support those stocks higher. This time is different. But as much as someone saying this time is different makes people roll their eyes, there's always a little bit of truth to it. Yeah, obviously, no two moments in history are going to be exactly alike, and one bull market isn't the same as the last. Understanding whether stocks can keep going beyond those high valuations means thinking through how things truly are different this time. The other side of this is, as Mark Twain said, history doesn't repeat itself, but it does often rhyme. A lot of times, there are common warning signs, commonalities in the market that you can look for to understand stock prices. One example here, Scott Nation points out in his book, A History of the United States in 5 Crashes, which is an amazing book, not only to understand stock market crashes, but for anyone that likes American history. But Nations points out the 4 common traits of most stock market crashes. In his study of 5 market crashes, Nations finds most see huge runs in the prices over the last 2 years. This is more than just that steady build in prices through a bull market, but returns of 20 or 30% and more as stock frenzy builds. Crashes also often come after some new financial innovation has been launched that people really don't understand. Things like the bank trust, investment trust, or portfolio insurance. These innovations often allow huge growth and leverage, allowing investors to borrow and bet trillions on rising stocks. And finally here, the government will step in an attempt to fix some market inequality with taxes, regulation, or reform, and will just end up spooking the market. 2 more of those worst investing ideas you'll ever hear. And next is telling investors to be ready for a 5% correction. This is yet again another total cop-out for the experts, presenting a positive opinion on stocks, but warning investors that there could be a 5 or a 10% correction coming. First of all, they rarely put a time frame on this, so it's just another one of those no shit moments. In a study of the last 20 years, Charles Schwab found the pullbacks of at least 10% happened in more than half the years, 11 out of the 20, and smaller dips of 5 to 10% happened twice a year on average. So warning investors of an eventual sell-off isn't much of a warning at all. It's gonna happen, and probably within the next year, but it doesn't help unless you put that time frame on it. But it's also just another way for market pundits to not take responsibility. They can be as positive on stocks as they want, tell investors what they want to hear, and if stocks end up falling, well, they warned you there might be a correction. To be of any use whatsoever, these correction warnings need to have a time frame attached. Why might stocks weaken and when within a span of a few months? They also need to offer alternatives. If stocks in a specific sector are going to weaken most, which stocks might investors look for safety? These predictions also need to tell you when to decide if that correction is still coming or if the risk has passed. We're almost there, but the next dumbest thing said on Wall Street is calling it a stock picker's market. Okay, I need a break here. Working through all these, it can be easy to get frustrated with the market, with all the bullshit that goes on, and this one is probably the biggest pile of the bunch. But what I'm trying to do here, what I hope you're getting out of this video is you can take these little nuggets of investing advice and you can use them to be a better investor. All it takes is just a little more research, looking at these things a little more closely rather than just accepting the most overused cliches and sayings. But this one, proclaiming a stock picker's market, is really just about as worthless as it gets. Now, the expert here is trying to say that the stock market is going to be volatile, could even fall over the period, and that you're only going to make money by picking individual stocks rather than investing broadly across the market. Basically, it's a way for those analysts and the portfolio managers to justify their 6-figure paychecks for picking stocks. The truth is that it is always a stock picker's market. There are always going to be individual stocks that beat the market and those that underperform. For you as an investor, it's not a question of whether you can get a better chance of higher returns, but what kind of investing best fits your personality. If you can take that higher risk and the volatility in your portfolio, if you don't mind spending the extra hours to research stocks and you can handle that stress, then you're going to want to pick stocks in any market. If, on the other hand, you don't want that stress, if you just want the market to do its job over time and make you money, then you're probably better off investing in those broad market funds and just getting that market return. And here, the number one dumbest investing advice you hear all the time: forecasting weakness far into the future. And this is like a game that analysts and pundits like to play called, I have no clue. This is where they'll take a position on the market, either positive or negative, but usually positive, and then give the conflicting position for more than 6 months out. So for example, the expert's going to say they think the market can continue rising, but then might face weakness in the second half of the year, or in the first half if they're already in the second half. Basically, this is just another meaningless hedge, so they don't have to take responsibility for a bad call. If the market keeps rising, well, they were right, and if that second half weakness never appears, and who the hell's going to remember what one opinion out of a dozens you hear every day? If, on the other hand, that weakness happens earlier, so if stocks start falling before the second half, the analyst can always say, well, I knew it was coming. It was just earlier than expected, but I did warn you. And just like those calls for a market correction, these need to have a time frame and just be better defined. Hell, some of these are even going to call for market weakness years out into the future. But to have any kind of meaning, they need to spell out the risks and the alternatives. Click on the video to the right for the 3 secrets the experts want you to forget. Wall Street's biggest lies, how to see through them, and how to make more money investing. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.